All right, if you are saving for retirement, you're going to want to listen up. A huge federal rule change is coming down the pike, and it could totally change your 401k strategy. We're about to break it all down, what it is, who it hits, and what you need to know.
So let's just cut right to the chase. Are you over 50, and are you a high earner? If you're nodding your head yes or even thinking maybe, then you need to stick around. There's a new rule coming that's aimed squarely at how you make those awesome extra contributions to your 401k.
And listen, this isn't just some friendly suggestion from your 401k provider. Nope, this is a new federal mandate. We're talking about something that's going to completely change a major retirement savings strategy for a very specific group of folks.
Okay, so let's get the key details out there right away. First up, the when. This all starts in 2026. And the what? Well, it's all about those catch-up contributions. You know, that extra cash people who are 50 and older can stash away in their retirement accounts every year.
So who exactly are we talking about here? Who is this specific group? It actually all comes down to just one number, a single threshold that decides if this new rule is going to affect you or not. So what's that magic number? Let's see.
And there it is, $150,000. That's the line in the sand. If your income is above this number, these new rules are for you. If it's below, hey, you can just keep doing what you're doing. It's really that simple.
Now here's where it gets really interesting and a little tricky. How they define income here is super specific. This isn't your total salary, and it's not your adjusted gross income from your tax return. Nope. The rule only looks at your Social Security wages, and you can find that number right in box 3 of your W-2.
Okay, so this brings us right to the heart of the matter. The real change here is that for high earners, a choice you've had for a long time is, well, it's going away. It's being replaced by a requirement. Let's dig into what that actually means for you.
This chart really lays it all out perfectly. Up until now, when you made those catch-up contributions, you had a choice, right? You could do it pre-tax, which lowers your taxable income today, or you could do it as a Roth contribution. Well, starting in 2026, if you're a high earner, that choice is gone. Poof. All of your catch-up contributions have to be Roth.
So let's do a quick refresher. What exactly is a Roth contribution? If you're not familiar, it's pretty straightforward. It's just money that you put into your retirement account after you've already paid your income taxes on it. Basically, you pay the tax man up front.
Here's the simple way to think about it. With Roth, you pay your taxes now. But what's the big payoff? Well, down the road, when you go to take that money out in retirement, it's all yours, completely tax-free. And that's not just the money you put in. It's all the earnings and growth over all those years, too. That's a huge deal.
Okay, so we've got the rule down. The million-dollar question now is, does this actually apply to you? Let's do a really simple check so you can figure it out for yourself.
All right, here's all you got to do. It's a simple 3-step process. Step 1, pull out your W-2 from last year. Step 2, look for box 3. That's your Social Security wages. And step 3, is that number over 150 grand? If it is, boom, this new rule applies to you.
Just to make this crystal clear, let's walk through the timing. It's your income from all of 2025 that they're going to look at. So once 2025 wraps up, they'll check that W-2 number. If you were over the 150K mark, then any catch-up contributions you make in 2026, yep, they've got to be Roth.
So, let's talk about who is not affected by this. Who gets a pass? Well, first, anyone over 50 who made $150,000 or less in Social Security wages the year before. You still get to choose pre-tax or Roth for your catch-up. And second, and this is super important, this rule only hits your catch-up contributions. Your regular, standard 401k contributions, they're totally fine, not affected at all. Okay, so we know the rule, we know who it affects, but what does this actually mean for you, for your wallet, for your financial plan? Let's get into the practical side of things.
This table really breaks it down nicely. Think about it. With the traditional pre-tax catch-up, you get that nice tax deduction right now. It lowers your tax bill today. But you've got to pay taxes on that money when you pull it out in retirement. With this new mandatory Roth rule, you don't get that immediate tax break, but the prize is on the back end. Your withdrawals in retirement are totally tax-free. It's that classic pay me now or pay me later scenario. Except for high earners, it's not going to be a choice anymore.
So let's boil it all down to the most important point. The bottom line is this. Starting in 2026, high earners are losing a really valuable tool they've had to lower their taxes today. That immediate tax deduction you got on those extra catch-up dollars, it's gone, which means you'll probably have a bigger tax bill now, and the government gets its money sooner.
But look, it's not all bad news. The really good news here is that you have a heads up. This isn't sneaking up on you tomorrow. You've got time to prepare. This is your chance to maybe chat with a financial pro, tweak your tax planning, and just make sure your whole retirement strategy is still lined up with your goals.
And that really leaves us with the big question, the one that you have to answer for yourself. Now that you know you're basically going to be forced to build up this bucket of tax-free money with your extra savings, how is that going to change your retirement strategy? Something to think about for sure.